So now let's look at Medifast through the standpoint of operations. The last video we did was an overview, and I think you should watch that if you haven't already watched it. But in terms of operations for Medifast, I think it's important to keep in mind that this is a place where this company doesn't perform stellarly. It performs very adequately, but because it has no debt and because it does a really good job of returning wealth to the shareholders, that it overlooks the fact that it's only a reasonably good producer in terms of operations. I haven't talked about this much, but I've set up a Twitter account that's at Robinson Stocks. I set that account up because it takes a few days from the time I decide to buy a stock to the time that I can get a video made and posted on YouTube. So if you want real-time information on my trades, if you want updates on when new videos are posted, and or you want news and thoughts on the market or stocks in our portfolio, then go ahead and follow me on Twitter. Also, please subscribe, like, and comment. It all helps as I'm trying to grow the community. Finally, if you have comments or thoughts on any of these things, I am interested. I'm not just trying to have a monologue. I'd like to have a dialogue with people. So feel free to give me your comments. I'd love to hear what you have to say. Thanks. So gross margins for this company are extremely high. It's in the top 10% of companies we've seen. That's something that it really excites me. I really like high gross margins. I think it shows that the company has pricing power. I think it shows that the company is selling products with this is one of the things that points to the fact that it probably does have some sort of consumer monopoly. Otherwise, I don't think it could continue to generate these kind of gross margins. They've been very, very consistent. In fact, since 2014, they've been going up. So I like gross margins a lot, which means that I love this company for this category. Here's where we see the company performing really well. The earnings for this company have gone up dramatically. They've gone up every year. There've been a few years where it's kind of gone backwards a little bit, but generally speaking, it's gone up. And if you look at earnings per diluted share, that's also gone up pretty well. So if you're patient and you hold this company, I think you're going to do great with it. Net earnings as a percentage of revenue have been solid. They're in the top half of company, top 25% of companies maybe. But the important thing is that really since about 2014, they've been improving and getting better and better. And so you have a company that's doing well in terms of earnings and yet even improving that more and more over time. It's a really good sign for this company's ability to continue to create wealth for us. So if you watch my videos, you understand that I really look at there being four sort of taxes that a company has to pay that I call operating taxes. The things that a company has to do, I wish it didn't, but it does. Selling and general administrative, plants and equipment, inventory, and R&D. What I like to do is see how well a company does in controlling these costs. And the better it controls these costs, the better the company, I think, is. And I think a lot of people overlook this, but I don't. I think it's really important. So selling and general administrative is extremely high for this company and is very, very poor. It's in the bottom 10% of companies, bottom 15% of companies that I've looked at. Normally, this would be the kind of thing that would disqualify my interest in a company. But the other categories before taxes seem to be doing okay, and the company has no debt, and we've already talked it as these really high gross margins. So this is the area where the company falls short. And the reason I think it is because selling. It is 24,000 independent salesmen out there trying to pitch their products. And I think those people get high commissions, and maybe commissions are too high, but I think it's just a cost of doing business for this company. You just have to accept it. Plant and equipment, this cost is going down. It's not fantastic. It's in kind of the middle of the road, but getting better and better every year. The company doesn't have a lot of facilities. It has a manufacturing facility, has a few warehouse facilities. It has a lease for its space in Boston, an office lease, but I don't think any of that's really a problem. I think they've got some centers that are out there, pitching their products as well, and haven't seen much data on how well those centers do. But in the aggregate, I don't think the company's big problem is plants and equipment, and it's such a small percentage of the revenues that I don't think it's something I'm going to focus on as an investor. We recognize that it's higher than we'd like, but not so high that it's a problem. So inventories and R&D. R&D, there isn't any, so we can cut that really quickly. The company has no R&D, so that's spectacular. That makes up for some of the evils of the company's selling and general administrative costs. The inventory bothers me a little bit. It's not great in terms of inventory, and more importantly, it's been getting worse over the last 4 years. Their sales are going up, and so maybe it's simply that they're keeping more and more inventory and they're not managing that sale very well. Maybe it's that they are producing some products as they expand that people aren't buying, and hopefully they'll figure that out and get rid of those products. But that's the kind of thing we want to keep track of. If inventories continue to rise to the point that they become a problem, it would be the kind of thing that might disqualify the stock, because it shows that their sales aren't what they're expecting. So, summary of the company's operations. The firm is a direct marketing firm. So think Amway. Generally speaking, these businesses get a bad rap. Often that's deserved, right? Obviously, often those kinds of companies have real flaws and real problems. But when they work, they can work very, very well. So if you consider that Tupperware is a company that seems to do a good job as a direct marketer, and Warren Buffett bought the Pampered Chef. I mean, what else do you need to know? If Warren says it's okay, and not to oversimplify things, but it almost means it's okay for me. This company has great margins, but it does have very high selling and general administrative costs. But again, I think that's due to the nature of direct marketing. So I just want to point out and make very clear to you that this company is only slightly above average in terms of its operations generally. If the whole company had sort of these kind of characteristics across the board, I would never consider buying it. So my interest in the company is not related to the operations. The operations are a drag, but they're not the end of the world. And the company does such a great job on returns on equity and returns on assets and returns on retained earnings, and it has no debt. The earnings are growing and the dividend is solid, and on and on and on and on. There are so many great things about this company that you just can't look at simply the operations, which aren't horrible, and say, well, the operations are only a 7, so I'm going to pass. So again, I think this is a company you should buy. I just think you need to recognize that it's not the Apple of well-run logistical companies.